A harsh truth is sinking in. America's jobs landscape is shifting, and the changes are making waves far beyond economic forecasts. If you're following the recent headlines or working in almost any industry, you've probably noticed an unsettling pattern, and the latest job numbers just threw it into sharp relief. But here's where it gets even more complicated. The July employment report, paired with significant downward revisions to earlier months, put to rest any wishful thinking about a strong job market rebound. Instead, it confirmed what many analysts and data watchers have been warning. The U.S. labor market is slowing down and struggling to regain momentum. The abruptness of this downturn caught many off guard. The revised numbers crashed expectations and even triggered heated controversy around how these figures are reported and interpreted. In July, only 73,000 jobs were estimated to have been added, a steep drop from the 115,000 economists had hoped for, and just half the preliminary number for June. To add insult to injury, May and June's job additions were revised down by a combined 250,000 positions, a considerable downgrade that has industry insiders nervously talking. After these changes, the 3-month average gain shrank to just 35,000 jobs. Aside from the early pandemic collapse, that's the slowest hiring pace in nearly a decade and a half, according to the Bureau of Labor Statistics, BLS. For perspective, the country averaged 85,300 jobs added each month so far this year, but that's a far cry from the 153,300 averaged in 2024, or the 466,850 per month during 2022's roaring post-pandemic recovery. Here's where debate gets intense. This move stirred a hornet's nest of debate, raising concerns about the politicization of economic numbers. Here's a fact most people miss. Revisions are standard in economic data, reflecting new and more complete information that can clarify or sometimes muddy the real picture. All eyes are now on the forthcoming August employment update, which many expect could offer clearer insight into the true state of the nation's workforce. Predictions suggest a modest 80,000 job gain, with the unemployment rate holding at about 4.2%. According to Dan North, Allianz Trade's chief economist for North America, we're witnessing a pretty marked slowing. So why is this happening? Some slowdown was anticipated as America normalized after a historic hiring surge following COVID-19. But the real question, one that is sure to spark plenty of discussion, is whether today's low levels of hiring and layoffs represent a simple lull, or if they point to deeper, structural changes in the job market itself. Federal Reserve Chair Jerome Powell recently called the job situation a curious kind of balance, arguing that slowdowns in both the demand for and supply of labor have created a job market that's neither overheating nor collapsing. Principal Asset Management's Seema Shah adds that disappointing payroll numbers might not mean the market is getting worse, but that fewer new jobs are needed just to keep employment steady right now. Several forces are squeezing labor supply. America's population is aging and immigration has declined, meaning there are simply fewer workers to fill openings. On top of that, unpredictable tariff policies from Washington have left many businesses skittish, holding back on both hiring new staff and making big investments. Employers are acting with caution, according to Elizabeth Renter, a senior economist at NerdWallet. Many are curbing hiring plans amid uncertain economic conditions. The silver lining, at least for now, is that they're also avoiding mass layoffs. The closest real-time indicator of layoffs, the Labor Department's weekly jobless claims, illustrates this caution. New claims for unemployment benefits haven't spiked, staying lower than at this point last year. Abiel Reinhart of J.P. Morgan even describes the outlook as reasonably optimistic. But don't get too comfortable. The number of people continuing to claim jobless benefits is nearing 4-year highs. This hints at something troubling. Workers who lose jobs are finding it increasingly tough to get rehired. One report that really grabbed attention is the latest job openings and labor turnover survey. At the end of July, for the first time in over 4 years, there were more job seekers than available jobs, Yet hiring, quitting, and firing barely changed. Could this be the calm before a possible storm of layoffs? There are already warning signs. In August, U.S. employers announced nearly 86,000 layoffs, up sharply from July, marking the worst August for layoff announcements since the Great Recession, according to Challenger Gray Christmas. Most companies cited economic and market factors, but there's also been an uptick in shutdowns, store closures, and bankruptcies. Now, here's a part most people don't realize. Economic data is revised all the time. As more details come in, and during times of economic transition like now, these revisions can be big. William Beach, BLS Commissioner during Trump's prior term, notes large downward revisions often happen as growth slows, and upward revisions come during recoveries. Some of May and June's dramatic recalculations were because small businesses responded late to surveys, or because state and local education jobs dropped off more than usual, screwing up seasonal adjustments. If you're banking on the next jobs report to stabilize the mood, be careful. There's weak correlation between 1 month's revision and the next, which means more surprises could be lurking. Dean Baker from the Center for Economic and Policy Research even predicts another downward revision for July. Here's a controversial angle. America's job growth is increasingly resting on just a handful of sectors, especially healthcare and social assistance, which accounted for all of July's net gains. Economists like Greg Dacko of EY Parthenon expect August to look similar, with most other industries, such as retail, manufacturing, and business services, either stagnant or shrinking. Is an economy dependent on so few sectors really healthy? These changes are hitting some communities harder than others. The unemployment rate for Black Americans surged from 6% to 7.2% over just 2 months. Its highest in nearly 4 years. Experts warn this could be the canary in the coal mine, foreshadowing wider trouble. CEPR's Dean Baker warns that another increase in August could signal a rapidly deteriorating job market for Black workers, a trend worth watching, and one that demands attention. Amid this uncertain outlook, wage growth appears to be fizzling. Average hourly earnings are projected to increase at just 3.7%, down from 3.9% previously. This wouldn't be so concerning if inflation weren't starting to heat up again, meaning workers might actually feel poorer, even if their paychecks are slightly bigger. Greg Dacko expects wage growth to dip further toward 3.5% by fall, as employers become thriftier. Finally, all eyes are on the Federal Reserve. Most market